At the time I'm doing this recording, the stock market is up, and according to the data, the economy is also growing at 3.8%. But even still, with all that good information, I am extremely concerned about the US economy. We've talked about how the job market is broken and how 1 out of every 5 jobs is a ghost job. If you've been on LinkedIn, you see how hard it is for people to find new jobs. You've heard about my story as well, but I've come across some really concerning data that proves this point. Even though the GDP numbers, gross domestic product, says, hey, everything is fine. And the stock market also says everything is fine. So what is actually going on here? Let's go ahead and break it down. And this is, I'm not going to call it a slow burn, but it is something you really want to pay attention to. I'm going to start off at the top here because I don't think that everybody knows this, but the stock market is not the economy. Now, yes, I'm a financial advisor and I deal with the stock market a lot as well as other things, and I also have a degree in economics. So I have a breadth of knowledge and training in the two, and they're loosely connected, but they are not the same thing. Far too many people say, oh, the stock market is up, therefore the economy is great. Not exactly. And here's a good example or a good illustration as to why they're not the exact same thing. For example, let's take Microsoft, one of the most valuable companies in the US, and obviously you can invest in Microsoft. Whether Microsoft hits an all-time high today or at any point, they hit a new profit number or whatever, that has nothing to do with whether you can afford groceries. That in itself is an example, one company, one family, is an example of the difference between the two. The reason why I say that is because 2/3 of the US economy is based on consumer spending, not corporate spending. Okay, it is consumer spending is what our economy is based on. Now, whether that's a good thing or a bad thing, that ain't the point. That is what it is. So are we, the people, able to buy and afford things, and are we continuously spending, yes or no? Now we'll get into that here in a sec, but that's the thing. The market can be up and has nothing to do with whether you can afford groceries or whether we as a people in general can afford groceries. So yeah, the market can be up, and what that has to do and what forces the market up or allows the market to go up can be a lot of stuff. It can just be interest rate. It can be just AI, which could be replacing my job or can be replacing your job, and you may not be able to afford stuff, but investors' expectations can be, hey, I think Microsoft's going to do whatever, or it can be a bubble, or it can be AI that can take your job and force you into a bad situation, but it can have investors to be overly optimistic about something else. So again, the stock market is not the economy. So let's take that and set it aside. Now that we got the stock market part out of the way, we need to move to GDP. And this is where you want to hone in. And this is the part that really scared me when I dug into the details. Now, GDP stands for gross domestic product, and there have always been issues with how we've calculated GDP. Now, again, even when I was an undergrad, we talked about the issues of how you calculate GDP. Now, I'm not going to get into the super hyper calculus of all of that. I'm just going to get just the basic math here, okay? GDP, again, gross domestic product, what it basically measures is all the stuff we produce as a country. The basic factors is you take what we are spending, government spending, what the investments, right, what our companies investing into the country. You add those three things up, and you keyword subtract imports. You are subtracting imports. Why would you subtract imports? You would do that because you're not producing that, you're just bringing it in. Now, I want you to think about that. What are you spending? What is the government investing? What are companies investing? Or what are governments spending? And what are companies, putting into the country? And then subtract imports. Now, think about that. Imports have the most interesting impact here. The more you import within a quarter, the more you have to subtract, and that hurts your GDP number. The less you have to import, the more that helps your GDP number, right? Because you're not subtracting as much. Okay, does that make sense? If you import a whole lot, remember you have to subtract the imports, you have to subtract a whole lot from the imports because that's a negative number, right? And then if you import a whole lot less, let's say I'm not importing anything, that's going to help you because you're not subtracting anything, or is a negative number and I'm subtracting a whole lot less than what I did the previous quarter. So that math is going to help you. Well, what happened in Q1? We talked about this. In Q1, before the president really took office and before Liberation Day, which happened in April, what did I say that companies were going to do? And what did companies do to try to avoid tariffs? I said that they were going to try and import as much as they could. To do what? To avoid tariffs. So if I could order as much as I could, get it here on shore early before those tariffs hit, that was going to help. What happened in Q1? We had a negative GDP. I will put the chart here and you'll see and read the fine print. You'll read the fine print right there of how imports impact GDP. So it says right there, but that is what happened. And it had the impact that you see for imports. So what we did is we imported a whole lot of stuff. It had the impact on GDP, and GDP was negative in Q1. Then in Q2, we did not have those imports. When you take away those imports and you're not having that same subtraction, what does that do? What did I say earlier? That makes GDP look a whole lot better. That is why, because of the import swings, that is why GDP looked so great. So what does that mean? If we didn't have it, we would be in a recession right now, because 2 consecutive quarters of negative GDP is a definition of a recession, because you have already seen what the jobs have been. So we've already got contracting economy, right? We would have had a contracting economy, and you've already seen how the job market is. Because the last time we had this, you also had to look at job numbers, you also had to look at a bunch of other stuff. So you've already seen that. And we've already seen a little bit of consumer spending and how that had contracted at certain times of the year. This is not good. This right here is not good because it's all about imports. And that one swing is the only reason as why it looks good. And this is right here, and the fact that we are not getting data right now because of the government shutdown, is the stuff that I have been warning people about. It looks good. 3.8% as a headline looks good until you look at why. And the reason why is because we imported so much in Q1 and didn't in Q2. And because that's a negative number in how you calculate, that little glitch, which has always been there, right? Which is the only reason it looks the way it does. And then you get to the spending part. For those who say like, hey, spending is still solid, we've already talked about this before. That is the hidden struggle, the hidden part, the hidden problem of the economy right now. The spending part of this is the top 10% of income earners are making up half of the spending right now. That's not a good thing. That is the highest that we have ever seen since we've been measuring this part of the economy. What that is really telling us is, and it's something we've never truly seen before, is when you have a mass of people, right? Let's call it the middle class. People say the middle class is vanishing and whatever in politics. But when you have a mass of people that are not doing well and we don't notice it, that's not good. Okay, the reason why that's not good is because previously we say, okay, let's stop, let's do something. There's a stimulus package or what, something would happen in the economy. The stock market would be down, the government would stop and do something. Some action would take place for us to do something differently. But now we're just getting headlines, economy is fine, stock market is up, rich people still spending, and they can just pepper over. Right? The economy can just run based on just 10% of people. That's not good, because what happens to the other 90% of everybody else if everything can run the same? If the entire stock market can just run off of the top 10 because they are pushing out all of the growth, which I've already talked about with index funds, right? And how they're being, I think it was like 60% or so. You can go back and check that exact video to get the exact stat of how they have been similar to the income stat, right? Whether it's Microsoft or even Palantir to a lesser degree, Nvidia, how they have been pushing the gains of the entire S&P 500 to a degree. That's not a good thing. That is extremely concerning. So with all that concern and anxiety, which all backed up by stats, okay, it ain't just me, but what should you do and consider? Okay, so number one, which I have been very, very loud about at this point in time, is consider building up your cash reserves. Okay, the reason why is not because there's some grand crash coming. Okay, I'm not that type of person. I'm not Robert Kiyosaki telling you to invest in beans. Okay, all that type of stuff. But I do think in this particular moment, just given the strangeness that we have, especially in the job market and other places, and the increased cost, I think beef in and of itself is 50% higher than what it was. We used to say, 3 to 6 months. I think it makes more sense to make that 12 to 18. Okay, I've said that before, so that's number one. Consider making minor adjustments to your portfolio. Yes, I think the stock market still makes sense, and adjusting what's in it may make sense, and especially now as we move into the last quarter of the year. I talked about international stocks, and we'll talk more about that here pretty soon, and as well as some other stocks here later in the week if we haven't released those videos already. And then gold. Gold is having a moment. It's been at an all-time high within the last few weeks or so, and could be at an all-time high at the time that you're watching this video. So making those small tweaks can be very helpful. But I think most importantly, having more cash is going to allow you to weather whatever storm could be around the corner and allow you to continue to invest uninterrupted. And that is the biggest thing. Regardless of how things are widening between the classes or whatever it is that you want to label it, investing is going to help to give you mobility and options. Mobility and options. That is going to be it. Now, again, I've shared my story, lost my job, to start my own business and do all that kind of stuff. I don't know where I would have been if I had not invested. Point blank, period. There was a small account that I started with like investing $20 a week. It was on public. Okay, we had talked about that. That account grew to more than $20,000 in 5 years. And what I've had to do, in addition to my savings, right? I had a cash savings, but I want to keep some cash, right? I've been dipping out of that every now and then. If I didn't have that, because clearly I want to pull out my 401k, but because that had been a buffer to keep me and help me to invest in my own business, to help me to keep the lights on and do all of that stuff. Investing can do that. And the only reason it had grown that way is because, one, had it for the long term, allow it to grow, and that's the one place that I can pull from without having all those penalties, type of stuff. That's one of the points. I'm not saying that you should pull from your investing accounts. It's not supposed to be an emergency account, nor was it an emergency account for me. Right? But there was a strategic way as to why I use that. And you want to have that option. What you don't want to do is not have savings, not have any investing accounts, and you only have a credit card, or you have none of the above. You don't want to be there. Okay? You want to have those choices and options. And the more you have invested, the more you have saved, the more choices and options you are going to have. And it is easier to do it now before it is too late. So I'm putting it out there, and I'm telling you now, I see the headlines, I see what people scroll by and share from time to time, and I know what it looks like. But when you actually click into the report and you go past the 38 pages, right, and some of these reports are long, and you go all the way down to those charts, it ain't what you think it is, especially when you dig in and compare quarter to quarter. So be extremely careful. If you want to know more about where to invest, especially if you're talking about international funds and gold and things like that, you want to check out these videos right here.